Bismillahirrahmanirrahim. In this video, we look at how reckless lending by banks leads to asset bubbles and how asset bubbles lead to the banking crises, and then how banking crises lead to overall economic crises and depression and so on. So recall how banks create loans. I've already explained this a few times in the past, but let's revise. So for example, there is a bank called HSBC, and there is a customer who comes to the bank. Customer, let's say A, comes to the bank and asks for £1,000,000. He wants a loan of £1,000,000. And the purpose of the loan is to buy a house. Okay, so A needs £1,000,000 to buy a house. So the HSBC, the loan officer, checks the credit score of A, and checks the credit worthiness and also the collateral, which is the house, and then the availability of the down payment. So for example, A has £200,000 available as equity, and the house is, let's say, worth £1.2 million. So the person has 200,000 in his account and he needs another £1,000,000 to buy this house. So the bank will keep this house 1.2 million as a collateral, as a mortgage against the loan of £1,000,000. And where does the 1 million come from? It comes from keystrokes. So this is the balance sheet of the bank. These are the assets, these are the liabilities. So the bank, just through keystrokes, will create a loan of £1,000,000, an asset, and then on the liability side, it will put in £1,000,000 in the bank account of the customer. A will have £1,000,000 in its account. So when the customer logs into his internet banking, he will see £1,000,000 in his account. Where did the money come from? It came from nothing, ex nihilo. It came from thin air. So bank has created this new purchasing power. It has created this new money worth £1,000,000. There is no gold. There is no fractional reserve system. Yes, the bank would need some reserves at the central bank for interbank settlements, but at this point, it doesn't need any reserves to create this loan. So that's in summary how banks create loan. So let's move on to the lecture now. So the first step is how can this lending become reckless? So there is a good way, a proper way, and then there is the reckless way. The reckless lending creates asset bubbles. So the asset bubble is entirely dependent on a continuous and ever increasing flow of new credit from banks. So let's say this guy A buys a house for 1.2 million, and then so the value of the house is 1.2 million, and 2 years later this guy wants to sell the house. So the customer B comes in, and then he wants to buy this house. Now, because of the increasing demand, the house prices keep increasing. So let's say the house price 2 years later is 1.5 million. So this guy wants 1.2 million as loan and 300,000 as his equity. So bank will again create new money, just type in numbers in the bank account of B, and this guy will buy the house. And this is how new money keeps creating in the economy, and the house prices, asset prices keep increasing. And the moment that stop flows, the moment that money creation flows, the bubble is doomed. The bubble keeps on growing as long as banks keep creating new money. And once the bank stops creating, then the market knows that the economy has reached its peak. So when banks stop lending, then this is the trigger. Suddenly the fuel for the fire is gone. So this is the peak, and investors typically are looking for the peak. So as long as the money lending keeps going, then the house prices keep going, and when the bank lending slows down, the economy knows that the peak has arrived, and people no longer continue to buy. So the house prices stabilize once the bank lending stabilizes. Now, what happens is the investors who invested earlier, they are the beneficiaries of the system. They invested earlier, so, so let's say the economy looks like this. So this is the booming part, and then this is the peak, and then this is of course the recession and downfall of the economy. So people who buy the house here at this point, they make a lot of profit because the value is low here, and then it keeps increasing. So people who buy house here at this point, they get less value, and then people who buy house at this point, they are the losers basically. So returns are paid to earlier investors using capital contributed by new investors. So people buy low and sell high. So the early investors are successful and the later investors are unsuccessful. So in the asset bubble, returns in the form of higher asset prices are only possible because new buyers are consistently entering the market using their bank credit. So people keep buying houses and asset prices keep increasing because credit is cheap and easily available. Now, when the banks stop lending, no new buyers can enter the market. So the peak depends on the bank lending. And the last people who bought assets at the peak are now stuck, and people know that the peak has arrived, and the belief that prices will continue to go up is shattered. Now this belief is shattered. So what happens? People know this is the peak. The prices are no longer going to increase any further. So that was the expected trajectory. However, the actual trajectory is downwards. So it starts going down because of the bank lending. Now people start selling. So panic selling starts as people try to cash out their profits before they evaporate. So now there is a downward spiral. So the asset prices have peaked. The trajectory is downwards. It's not as per the expectation. So people start selling. So there are more sellers than buyers. So on one side, people want to sell, and on the other side, there are no buyers. So at this, let's say 1 million, it was the house price here. Somewhere in the middle, it was 1.2 million. And then now the house price is, let's say, 2 million pounds. So at 2 million, a lot of these house owners would like to sell their house, but there are no buyers because there is no bank lending. The expectation is that the economy is going down now. So bank lending stops or reduces. So people start selling their houses. So there are more sellers than buyers. So what happens? The law of supply and demand, when there are more sellers, the house prices start falling. And they fall rapidly, they plummet because there are much more sellers than buyers. and this leads to a downward spiral of asset prices. Okay, now this leads to a banking crisis. How does that happen? Now, as the asset prices fall, it affects the entire banking system. So banks created billions and trillions of dollars of loans using the inflated real estate as collateral. So let's say this house was 1.5 million pounds here. The bank had lent 1.3 million pounds. So at that point, the value of the collateral was 1.5. So the bank was fairly confident that even if the price drops, it would be able to recover 1.3 million out of the 1.5 million. However, once the panic selling begins, the house price falls to, let's say, 1 million pounds. So the bank has lost 300,000 just on one house, on one loan contract. So an example, a property that was valued at, let's say, $10 million and the collateral for a 9 million loan. So the loan was $9 million and the collateral was 10 million. So there was a buffer of $1 million. Now, so let's say the house prices fall and then the house price is only $2 million. So for a $9 million loan, the collateral is only worth $2 million in the market. So the loans become non-performing, and even if the bank exercises the collateral, it's only going to get $2 million. So it is facing a loss of 7 million just on one loan. So imagine if a bank has 10,000 such loans, then the losses will go into billions and trillions. Now, once the default begins and people start to default on their loans, then the entire banking system is affected, and the banking system affects the entire economy. Now, banks have a very small capital buffer. So when billions in loans become worthless, these losses wipe out the bank's entire capital. So there is some 8% capital which the shareholders invest, but the loans are much higher. So just what a 10% loss on loans will wipe out the entire capital of the bank and cause them to be bankrupt and insolvent. So the surviving banks are terrified to lend money to anyone for any reason. So overall, because the economy now is in a down state, then banks are not lending anymore. And this starves the real economy of the credit it needs to function and grow. The modern economy runs on bank credit. So when banks stop or reduce their loans, then there is an overall fall in the growth of the economy. Now, without access to credit, now businesses start failing, unemployment rises, and the economy grinds to a halt. And that leads to a recession. Now, in short, the causality goes as follows. Banks' reckless lending causes asset bubbles. So banks create new money, people keep buying houses, and asset prices keep increasing. And banks continue to do that. Banks give loans for houses to anyone, just any Tom, Dick, and Harry without any assets or without any regular income. So reckless bank lending leads to asset prices increasing. Asset prices increase, that causes a bubble in the economy. Now, at some point, when the banks stop the lending, when the economy slows down, then people know that there is a peak, and then the people start selling their houses. Now, once people start selling, and the economy knows that the peak has arrived, there is no further profit to be made from houses, then there are more sellers than buyers, and then the house prices plummet and crash. So when that happens, that leads to a banking crisis. Banks start failing because their collateral is insufficient now to cover their losses. So banks fail, they close down, and when banks fail, then of course their staff, they lose their jobs, and other banks stop giving credit. Overall, the entire economy slows down because modern economies run on credit. So the economy slows down and the unemployment increases, and then the GDP falls, and we are stuck for a long time until the government steps in and adopts expansionary fiscal policy, i.e., until the government comes and saves the economy either through spending or through reducing the taxation or a combination. So that's in brief how banks cause economic crises and banking crises based on reckless lending for asset purchases.